Hey YouTube, this is Zach with Achilles Financial, and today I'm going to be talking about two key investment options that you have available to you by way of dividends and certificates of deposits, also known as CDs. It's important to note that this video is strictly going to be coming from some random guy on YouTube, not a financial advisor. I'm just someone who has invested in both dividend producing stocks as well as CDs or certificates of deposits. Admittedly, my experience there is much more recent. So what I am showcasing here on the screen, this is utilizing TD Ameritrade. We are leveraging one of the screeners that I have set up, and this is something that I run fairly often. What this is doing is showcasing companies that have a dividend yield of between 5 to 8%. They are classified as large cap, so they are larger companies. They have larger capitalizations. You can see those available here. And then the profit margin for these companies are generally very, very strong in the 25 to 80% range, or 25 to 50% range. The reason why I've chosen this criteria is because generally if the profit margin is this strong, that means the company is going to continue to be around. If they are a large company, again, they just have that staying power. And then the reason I've selected dividend yield for 5 to 8%, generally this is what I would classify as a great dividend. There are some companies that will have higher than that 8% range. Generally speaking, whenever I see something higher than 8%, I tend to think that it is too good to be true, and some of that could be pushed out that way due to special dividends or preferred dividends. The reason, or what we're going to focus on, I'm going to start with Philip Morris as my company of choice. And this is a company that pays a very strong dividend. If you look at their calendar, you can see how often they pay dividends. So you can see that ex-dividend date, you can see those past dividends. They have been incredibly consistent. They continue to raise their dividends. And again, it's just a company that does very, very well. So if you see this over 10 years, you can see they're paying that quarterly dividend. And that is something that has continued to increase over time, despite the fact that the stock has seen large fluctuations north as well as south. So the company itself, they're very profitable. They have strong brand recognition, and they continue to perform very, very well. So why are we talking about them? What are some of the benefits associated with looking at dividends? The first and foremost is going to be here under the income estimator. So if I am clicking on the income estimator for this company, you can see that when I pull up Philip Morris, it gives me the opportunity to talk about a percentage or how much I'd like to purchase. So if I want 100 shares of Philip Morris, and this is something that I can start by paying for 100 shares. Currently at the current stock price, it's going to cost me $9,479. The nice thing here is, as you can see by the graph here, is it is going to provide me with $127 or about, we'll call it just over 1.5% return on investment every 3 months. So that is a quarterly dividend. So you can see that over the course of the year, that'll net me $508 a share. One of the advantages of these is that generally speaking, this is going to be in a more favorable tax bracket. So this is qualified dividend income, which is generally speaking, or rather can be different than ordinary income, depending on how you recognize it. So if I have this $9,500 right here, one of the things that I can do is defer paying taxes on that, and feel free to consult with someone other than myself. I am by no means a tax professional. I'm just some guy on YouTube, so want to throw in that disclaimer. Please, everyone has a unique or has their own unique dividend and investment strategy, and that should accompany a unique tax strategy. So now that I've cleared myself, just recognize that dividends are taxed generally different than ordinary income. One of the advantages of dividends is, generally speaking, you can leverage a DRIP strategy, and so that dividend reinvestment program, where this $127 that you would get in April, you can re-put that back into the stock where it will buy more shares at the current price, thus further delaying when you would take that income recognition. So the nice thing here is you have access to all of these options. The other nice thing for when we're looking at and or evaluating different income strategies with dividends is at any point in time of the current market value, again, this is going to go up, it's going to go down, you can sell this, especially with a large company like Philip Morris. The stock is very liquid, so you have the capability to sell that stock. So that is a huge option that you have available to you. So some of the advantages here, Again, you have capital gains associated with this, there are tax advantages, and you can always sell it, which provides an additional layer of flexibility. So therefore, what? Sounds like there's a lot of great things associated with dividends. Well, one of the things that I would highlight is the cons. You are definitely going to be opened up to market risk. So when you're looking at the stock right here, if you purchased at this point in time, way back in 2014, when the share price was $85 a share, you have still benefited from the stock going up. However, during that time period, you saw the stock up north of $110 a share, and you've also seen it under $70 a share. So while the entire time it's been paying a dividend, you're going to have to deal with that risk of it's going up, it's going down. Do you buy? Do you sell? How does that fit in with your tax strategy? So that's something you have to acknowledge, is that this is generally speaking going to have that market risk component. The other thing is that this dividend is not guaranteed. Philip Morris continues to perform very, very well. They continue to issue that quarterly dividend, and they've done so for a very long period of time. So you can see the stock going all the way back to post 2008 has been issuing that quarterly dividend. However, in the event that there is going to be a crunch on the company itself or downward pressure on profit margins, you could see the dividend either be cut or go away altogether. So that is one of the risks associated with certificates of deposits. Now let's talk, or rather one of this risk associated with dividends. Now let's talk about certificates of deposit. So again, I am in TD Ameritrade. We have the capability to go over to their platform to look at the bonds and CDs overview. So what I'm showcasing here on the screen, we have the capability to look at CDs right here. Again, certificate of deposit. This is generally going to be purchased from a bank or credit union. What this is going to do is, generally speaking, provide you the capability to have a fixed interest rate in exchange for keeping your funds at that institution for X period of time. So if I say that I'm going to get or keep my money at this bank for 3 months, then they are going to provide me an annualized rate of 5.16%. So essentially take a quarter of that is what you would get on that money. In addition to that, one of the nice things associated with this is I know my money, hopefully, present banking crisis excluded, generally speaking, you should feel very, very safe that this money is going to be there. If you put $1,000 in for the 1-year treasury, you are going to get $1,000 back plus some interest income over time. In addition to that, and we'll dive into some of the CDs available here, and you can look at the different options. When we're evaluating some of the different components and the different areas that you can purchase some of these different items, you can have or tailor what you would expect your yield to be over that time period. So you have the capability to build what's called a CD ladder. You can see those right here, where we can say I'm going to purchase 3 months, 6 months, 9 months. So if I have $30,000, I can go 10, 10, 10, and that allows me to continuously have access to my money over time. And it gives you the capability to essentially guarantee that you will have access to that money 3 months from now, 6 months from now, from 9 months from now. In addition to that, and I'm reading this here, so I want to call this out, CDs are also guaranteed up to $250,000. So as you continue to see downward pressure on regional banks and other things going on in the banking space, recognize that unlike stocks, this money is safe. So you have the capability to always get this money back should that amount stay under $250,000. In terms of some of the risk or the why would we not invest in these is, generally speaking, the average return on stocks over the past, I believe, 50 years or so has been 7%. So what you are lacking in risk and making up for in safety, you are going to see on the potential returns. Again, $1,000 in, $1,000 back, plus interest. So you have the capability to miss out on potential returns that you would see in the stock market. Now, in addition to that, there's generally also going to be a longer time period where you won't have access to your money. So if I pick the 1 year here, I do not have access to my money for 1 year. Stocks, on the other hand, are going to continue to see that high level of liquidity where you can buy and sell as long as there is a buyer and a seller. In addition to this, one of the other things or cons associated with CDs is in a high inflation rate environment, your fixed rate CD can bring on some serious pain. So what we saw in 2020, CD rates were under 1%. When those were under 1% and inflation was so much higher, if you invested in a CD, the worth of your money would have been significantly lower when you pulled that out. So therefore, what? We've got CDs here, we've got stocks. What are some of the capabilities associated with these two investments? At the end of the day, you always have to evaluate your risk tolerance. This 1-year CD, 5.4% compared to the average stock return of 7%. If you are a high-income individual on the brink of retirement, generally speaking, this is going to be a safer option for you. You don't need to have a high-risk investment. You want something that is guaranteed. So the higher risk you are, the more you're going to favor the stock investment versus the CDs. In addition to that, some of the things you're going to evaluate is your income and tax strategy. Once again, I am not a tax professional or even a financial advisor, so please speak with one before making any of these decisions or do your own additional due diligence. It's important to note that when you're evaluating this, again, 1 year, if you have $100,000 you are investing, you will get more than $5,400 back in interest. If you have dividend stocks, that is going to be a different ROI. You are also going to be taxed differently on those two investments. So because of that, you need to evaluate what your time horizon is, what your income needs are, as well as your tax considerations. So feel free to check out both of these offerings with your broker or your local financial institution. There is a lot of benefit to both of these options, and it's something that everyone should at least consider and evaluate as we continue to see additional volatility in the stock market today. So if you have any questions, please drop those in the link down below, and I look forward to seeing what CD rates do over the coming days, weeks, and months, as well as what happens in the stock market. So appreciate it if you've made it this far. Please leave a like and subscribe.